Having stocks and bonds in your 401k is like playing Monopoly. Everyone sees the board, the rules are clear, and you know when you're about to pass go or go to jail. Now imagine the game gets expanded, but only a few players know what the new pieces are. That's what could happen to your 401k. On August 7th, President Trump signed an executive order that opens the door for alternative assets in your retirement plan. Two of these assets that raised a few eyebrows are private equity and private credit. That's because these are obscure, complex, potentially high-stakes investments, but also possibly high reward. For decades, only the top players got to roll the dice on private equity or credit. Now, ordinary players could get a seat at the table. But should you risk your retirement money in this game? Here's what you need to know. For decades, private equity and private credit have been legally restricted to accredited investors. These are people with high net worth or high income and large institutions. Now the Trump administration says it should be available to everyone, in the way most Americans save for retirement, 401ks. To wrap my head around this shift, I spoke with Isabel Wang, a MarketWatch reporter who has been reporting on the changes that might be coming. Can you tell me, just to start, what is private credit and private equity?
So private equity is investment in businesses that are not listed on public markets or secondary exchanges. And private credit is privately negotiated loans between borrowers, like small to mid-sized companies and non-bank financial institutions.
So on August 7th, Trump signed an executive order. And in his words, it was democratizing access to alternative assets for 401k investors. What does this mean?
This order serves as a directional guidance to include the so-called alternative assets. That includes crypto, real estate, private credit, private equity to your retirement accounts.
Focusing just on private credit and private equity, why would it be helpful to have that in your retirement fund?
It's very likely that investors will get higher return from those private assets because, for example, private credit can give you an average yield of between 8 to 12%, compared with just 4 to 6% for public loans like treasuries or corporate bond. So that's a pretty attractive yield for retail investors.
And how about the reasons why it would be a bad idea to have these in your retirement fund?
The liquidity problem is really important to know here because there's something people call liquidity mismatch. And that basically means every time when you try to get your money back or sell your position in an investment, it's kind of impossible to get that money back on the same day. You have to wait for a couple days or even a couple weeks to really retrieve that money from your previous investment in the private assets. It may not be a big problem when the markets are not really volatile or nothing has been going on, but it could be a major concern for you or the overall economy if everyone is stuck in there when there's a big market downturn. The lack of transparency is another big problem because those private companies are not required to disclose their financial information to the general public. So it's kind of impossible to understand what it is really worth. And of course, what are the risks? And also not to mention the cost. It's pretty expensive to ask your portfolio manager to do it for you.
But before you start doing your own pros and cons list, let's be clear on what this order does and what it doesn't do.
It's important to know that his executive order doesn't indicate any immediate change to the policy. It just serves as directional guidance for government agencies like the Labor Department to re-examine the guidance to employers and to see what are the regulatory changes needed to facilitate the process of bringing those private assets to your 401ks.
Right, so we're not going to see private credit and private equity in your 401k tomorrow.
No, it's still unclear how or even whether the private assets will eventually enter our workplace retirement account. We may wait for a couple years for policymakers and regulators to finalize the guidance or the rules on how employers are going to put private assets to your 401ks, and most importantly, how to trade them, how to value them. But one thing is for sure is a lot of the Wall Street firms and asset managers like BlackRock, Vanguard, State Street, they are working with private asset and private credit and private equity firms like Apollo on expanding expanding the retail investors' access to those private assets. That's the trend that's been going on Wall Street for at least 2 years.